In this episode, Ryan and I discussed the fees and the cost associated with the infinite banking concept and becoming your own banker. We had fun. Hope you enjoy it, and thanks for listening. Welcome to the Banking with Life podcast. I'm your host, James Neathery.
And I'm your co-host, Ryan Griggs.
And as usual, we're having fun. This is literally unscripted, right? It's like, what do you want to talk about? What do you want to talk about? And
we come up with something good, though, each time, I think.
I have fun. I mean, and actually, I enjoy listening to our podcast.
Oh, I was going to say, I thought you enjoyed listening to me.
Oh, I do. I do.
Yeah, me too.
Yeah, I enjoy it, and everybody else enjoys listening to you as well.
Thanks. Lay it on.
You need some reassurance? No, literally, we're having fun. We're going to talk about some things that we just decided upon right before the camera came on, and I hope you enjoy.
So why shouldn't you do IBC? What are the costs? What are the fees involved? As a recent prospect put it to me, he's like, well, I do my best to minimize fees, to minimize costs. I change banks when they charge me too much on the checking account, change brokers, use a discount broker and all these.
Using 0% credit cards if he has any. The
fee conscious, right? Which is good. We should all be cost conscious. So what are the costs involved? First of all, I've read Becoming Your Own Banker. This sounds too good to be true, so there's got to be a catch. The catch is probably in the costs. And
right. So then,
what are the costs?
Then I go on YouTube or social media, Google, whatever, and I find, just do a little searching, infinite banking concept, wherever you start. And then if you keep searching, it winds up to Birmingham, Alabama, the Nelson Nash Institute, infinitebanking.org, because he created the concept, right? But along that journey, you've got to sift through a bunch of stuff. And a bunch of smoke and mirrors, rainbows, pixie dust, unicorns, right, to get to the truth. And so, and I'm saying that to bring out the point that, when you go through all of these quite often when you go through a bunch of examples of running money through life insurance policies, putting it on a spreadsheet, getting out of debt or whatever it is, getting a HELOC, go buying some turnkey real estate, it's very easy for the costs to be jump smooth over.
And
it's like, don't focus on that.
Don't look over here.
Yeah, don't look over here because look at how great this is, and it is very good. But then too, let me say, your opening question was why should I do the infinite banking concept? Who shouldn't practice the infinite banking concept? And beyond the fee conscience, I think it's people without any discipline. If you have no discipline,
right. So that's one of the costs. What are you going to be
successful at anyway?
Yeah, so that's one of the costs, right? You've got to have the discipline to build capital. You've got to beat Parkinson's law. Right?
Every day.
You've got to be able to make more than you spend, keep it around for a little while.
Isn't that fundamentally true? No matter what you do, you have to spend less than you make. Oh my gosh.
Yeah.
Okay. I didn't want to.
So the discipline to save is is the first cost, and there's going to be a loss in your ability to consume, if we put it technically, or
deferral of your consumption.
Yeah.
And you also have to invest a little bit of your time in reading and educating yourself.
Absolutely. So some more cost in the form of your time. The time spent online, the time spent listening to this podcast, the time spent reading Nelson's book, the time spent sifting through those less desirable resources online, perhaps.
You're so professional. I appreciate that.
Yeah, I try to be, dignified about it. But, so you've got to invest a lot of your personal time and energy. Time's your greatest asset. Can't make any of it back. I think those really are a lot of the material upfront costs that people can jump quickly over.
And those particular costs aren't readily quantifiable.
Yeah.
So with the fee conscious person or the commissions, because that's a bad word, right? Don't want the agent or the professional to get paid or overpaid, right? When you get, right down to the numbers and what are you actually paying for, what items are you paying for? What is the cost? You know, numerically, financially, the money. We're gonna cover some of those in detail. But let me say that I don't care what you do for a living, you're earning an income. If it's 1099 income, interest income, W-2 income, bonuses, commissions, we're all enumerated in some way. And I understand that nobody wants to overpay for anything, right? But in this industry, in the financial world, it really gets down to, from the client's perspective, most of the time, what are you getting paid in commissions and what do I have to pay in fees, whether investment management fees, trading costs. And two, I say it all the time, the consumer pays for everything. But make no mistake about it. We all know that. Right? Yeah. The consumer, you, me, us, we pay for everything. So
there's really two levels there. There's so we kind of covered the non-financial, non-numerical things, right? You got to have discipline, got to be willing to save, beat Parkinson's law. It's like, okay, well, get into the numbers. Show me the numbers, right? Everybody wants to see the numbers.
Let me see the illustration.
Right. So on one level, there's costs built into the structure of dividend paying whole life.
You mean life insurance cost?
Yes.
What?
So the cost of doing business, the overhead, the mortality expense, all of that's built into the product itself.
But I hate life insurance. I don't want them to be profitable.
And
I don't want to pay them anything.
On another level, there's how the agent gets paid, right? And sometimes those two things can overlap, right? The what the agent is paid can be involved in, is accounted for in the cost structure that's bound up in the premium and dividend paying whole life. And then there's other scenarios where an agent can get paid in what they call fee only, where they're going to charge the client something.
Oh, now we're in the investment world. A fee only advisor, is that one?
Well, there's fee only, and then there's fee based, and then commissions only. So fee only, they're charging you either a percentage of assets or some
assets under management,
or a dollar amount for their time, right? It's an hourly fee. Okay, so that's fee only. Then fee based is a combination of fee only and commissions. So they're getting something from the company that provides the product, and maybe they're doing assets under management or charging for time.
So if I go down to the local investment house, right, and I pay them a fee, whatever, there's with mutual funds, there's front end load, low load, A, B, C shares, right? And you get paid at the beginning, or you get paid at the exit, or you pay a higher management fee over the whole time period of owning that account. And I'm bringing this up because it's true that within that financial office, and I'm not picking on a particular company, but let's say they're typically presented as financial planners or investment office. You go in there and they're typically sell mutual funds. They may sell some stocks too, but then there's always that variable annuity or these annuities that they offer. And typically you find within an office or within a practice, they only write one or two companies, and so they're shelved products, right? They might be even white labeled, and an insurance company's underwriting or really is, and they might white label that product. My point is this, that why are there only 2 or 3 companies on their shelf? If there's 20,000 commercial annuities, in my example of annuities, if there are 20,000 commercial annuities available on the open market, why does the investment advisor typically only have 1, 2, or 3 companies and 1, 2, or 3 products in there? They're commission-based products, right? Insurance products are commission-based products. Investment products are typically fee-based products. So my question is this: why are there only 1 or 2 or 3, a limited amount of choices, right? And so the advisor may be getting a commission on that, but something else is going on that you don't readily see. Somebody else is getting paid to have those products on the shelf. So there's sometimes hidden fees that you don't see. Is my only point.
Okay. In the fee-based world. where they're doing both insurance and some investment options.
Yeah.
All right. So then there's us, where we're just commission based. So there is no fee for time for the dividend paying whole life IBC style sort of business. So two different levels there, right? The costs involved in the product itself, and then how the agent's getting compensated, and there may be some overlap there. So things to be aware of that people typically, if they didn't know about it and they see it, the eyes perk up and they get real suspicious, start side-eyeing you, right? So different things that you'll see throughout an educational process when you're going to become your own banker. Okay, so there's going to be what's called a PUA expense charge.
Paid up additions rider.
Yeah, every time you make that PUA premium, there's an expense charge, particular percentage, calculated based on the amount you're paying there, right, at that time. You're going to see interest on policy loans, right? Oh my gosh, I've got to pay interest. This is something we've talked about before, right? Paying money to the insurance company to receive a policy loan, right? This is money that's not going to build cash values, dividends, or death benefits. It is interest. Of course, you have very cost-effective, efficient repayment with policy loans relative to other instruments and other subjects we've talked about in the past, but there is an interest cost to getting policy loans. And then sometimes there's a term rider that will go on these policies. That's going to have a premium, right? So you've got a PUA expense charge. There's a premium for the term that could be on the policy.
Any other riders that you typically put on policies, generally they all have a cost. Most are, up front. Some are. Like, and specifically, I'm talking about the extended care type riders, the accelerated death benefit riders.
Waiver of premium.
Well, waiver of premium has an upfront cost. If you have waiver of premium, you're going to pay that cost, right, for that rider. And there are other riders that may be a specified disease, heart attack, cancer, stroke, or, long-term care type. And some of those riders have upfront premium cost, and then some have the cost is at the time of use, right? But there's still a cost associated to it, right? Until you can have other insured riders, guaranteed insurance purchase options. So most all of the riders that you can put on a whole life policy have a cost. And most all of them they all have a cost, but most of the riders have upfront costs.
Yeah, and I found too, and whenever I've had the unfortunate experience of looking at other agents' illustrations.
Why would you do that?
What? Because it is unfortunate. Oh, you mean why would I look at it in the first place?
No, it's a fair question.
It is a fair question, and
are you learning what to do or what not to do?
I am learning, that's for sure. Yeah.
You're going to learn one of the two.
But in these,
did somebody? No, seriously, don't jump over that question. Did somebody force you to look at? Because quite often, I feel twisted into it. I certainly don't want anything to do with other. Here, Ryan, I've got this illustration from 15 other agents. Can you run that or tell me what, is it like a drive-by second opinion?
Oh, there it is. Yeah.
I've talked to everybody in the country but you, James. Can I spend 20 minutes with you to make my decision? No, you can't. No. You can spend 100 hours on YouTube and watch all the videos.
Plenty of material that's out there.
Right. Yeah. And if you can't watch those videos and decide that I'm either a good guy or a bad guy, so you can either we can relate and work together or we can't.
Yeah.
20-minute phone call is not going to do it. That's my only thought. So you felt your arm got twisted into what?
Right. So on my off days when I don't do well.
You mean you don't work all the time? You take time off?
I'm saying on the days where I make the mistake of indulging the individual's
okay, then desire. It's a mistake.
Yes. So on my mistaken days, thank you for helping me articulate that. On those days, I look at these policies built for infinite banking, right? And they've got all these other riders on there. And it's like, what's that for? What's that? And you ask them and ask the prospect or the client.
The agent put them on there, right?
Okay.
I don't know what was there.
Well, no, that's about as good as it gets.
Okay, well, let me also say too, when it comes to the paid up additions rider, and this to me matters. When you look at a construct of an infinite banking policy, let's just go back to the originator, the author, Nelson Nash. In his book, Becoming Your Own Banker, he typically, every time, you don't see a term illustration in there. He did not use term riders on his policies. There was a base whole life premium, and there was a PUA premium. And then it seems like lately, the more people that get exposed to the infinite banking concept, and at the end of the day, I think, and I've said it many times, every worker is worthy of his hire, but agents that want to practice the infinite banking concept and promote it, right, and then hold themselves out as experts. And my God, anybody with an iPhone in a mama's basement can create videos, right? And no disparagement. I mean, some of these kids have 20 million followers, these influencers. I mean, my hat's off to them. God bless them. I'm not talking about them. All right.
We're talking about the less successful ones.
Yeah, right. So they, and I've said this, and we've talked about this several times. I presented at the Nelson Nash Institute about 3 years ago on the structure of a policy, which I think is very important. And my point is this: you get to the PUA. Nelson, in his book, Becoming Your Own Banker, he did not use term riders, and he basically had about a 60-40% split in premium. I'm paying $100,000 in premium. About $40,000 went to the base. $60,000 went to the PUA. And I get it. Those illustrations were created in 2000, revised in 2010, specifically speaking about equipment finance. The sixth illustration was created in 2010. Okay. So over the last, several months, last year, 18 months, something like that, it seems like there's so much of a focus on what's the correct percentage split between the base premium and the PUA premium.
Yeah.
Like at the end of the day, that's the most important thing to be determined when it comes to putting your money into properly structured dividend paying whole life policies.
Yeah.
And so if I continue, if you look at the PUA, which you had mentioned, has a charge. It has a fee. It has an expense charge. And they vary across the country with companies, anywhere from 0% to 14%, 14 cents out of every dollar you pay into the PUA with one particular company is going to the privilege of putting money into the paid up additions rider.
Right.
All right. So when it comes to a construct, there's a base whole life and a PUA. That's what Nelson did. And now we go forward today. Interest rates have come down. Dividends have come down. And a lot of questions are, do you use term riders on your PUA? Yes, we do. In every case, no. But we use a lot of them. Why? We raise the death benefit with the term rider to avoid the MEC. So you can have a higher premium amount going into the PUA. All right, now the life insurance companies have come out, and they've been out for a while with, and so if I back up, there's a base premium and a PUA is what Nelson did. And a lot of agents have put term riders on there in addition. So there's three primary parts to the premium. Okay. But they're standalone. That term rider is a standalone term rider, and it of course it has a cost. And it can be convertible, and so you're going to pay a higher premium for a convertible term than just going out into the open market and buying a cheaper term policy. But when term riders are used in the infinite banking concept, they're typically structurally important to that policy. So you're probably not going to convert it later. Okay. Then the companies have come out with a blended PUA. So the PUA rider to take the money without MECing internally has term. So the term and the PUA are blended PUA. All right?
Yep.
Okay, now you tell me, what happens to the cost of term over time?
Goes up.
Goes up. Every time I have a birthday, I'm getting one step closer to mortality. All right? So the cost of that PUA, if I use it, is going to continue to go up. Now, let's think about this, and I might be going off too far on this with this particular podcast, but I hope the listener appreciates.
Us here?
Right?
No.
Now let's just think this through. I'm 56, right? I have a blended PUA, and no, I don't personally. In my example, let's say I did. I want to pay a high percentage of the premium into the PUA, and so I'm going to use a blended PUA rider. And now I've got a substantial amount of premium into the policy, therefore a substantial face amount and cash value. And the cash value, I'm going to supplement my income in the future. And I want to do that through loans because loans are tax-free. Mm-hmm. Yes, I can make withdrawals from the PUA, right? Okay. And it's my choice. I'm in, quote-unquote, passive income time.
Yep.
Retirement. All right. I'm taking income to supplement my income or do whatever it is I want to do. Mm-hmm. Give it away, buy turnkey real estate, right? Whatever it is. The loan is I'm borrowing against that cash value.
Right.
All right. And so I'm either going to pay the loan back or I'm not. Mm-hmm. If I don't, that loan's going to compound. Mm-hmm. All right. Now I'm in passive income. I'm taking passive income through collateralizing my cash value. Does that sound like a loan I want to pay back out of my cash flows? Not necessarily.
Yeah.
Maybe, maybe not, because I know the death benefit collateralizes the outstanding loan. All right. So I can only borrow against my cash value. Mm-hmm. And if I borrow money every year from the life insurance company collateralizing my cash value, I'm going to have a compounding loan.
Right.
And the loan can't not out compound the cash value. And the cash value or the outstanding loan cannot out compound the death benefit.
Right.
Okay. So I'm taking income through loans that I'm going to let the death benefit pay back. Mm-hmm. I mean, I don't have to do that, but that is one thing that you can do. And now, if I've got a blended PUA, all right, I mean, how much of that premium can I reduce? It's a fair question. If I have a blended PUA, there's a term rider in there, and I reduce the death benefit, all right, I can only reduce the death benefit so far, or the loan's going to out compound the death benefit, and then I'm going to have a MEC, a modified endowment contract. Okay. So I'm just saying the PUA does have a charge, 0 to 14% of every premium dollar you pay into the paid up additions rider across North America. All right. Mm-hmm. Then we have a blended PUA that has a built-in term. The term has a cost. You're paying for it either through dividends or PUA surrenders or however the company constructed that. Mm-hmm. And I need a high death benefit so it can collateralize a high outstanding compounding loan that's being borrowed against the high cash value. I'm just saying, think that through. There could be a potential problem in the future.
Yeah, I think anytime these companies try to package things or anytime they try to mess with the fundamental features, right? So maybe we're blending a PUA and we're blending term, or maybe we're exposing the cash value / account to whatever indexing.
Oh wait,
market, right?
I get a choice now. Yeah, that's the latest thing. Yeah. Is like, can I have a dividend
indexing the dividend? Yeah. So there's all sorts of attempts by the companies to play these games with the features and just to make something seem more complicated, because complicated means sophisticated.
And they want to compete in the marketplace. But you think about that, this whole idea of becoming your own banker did not come from the life insurance industry. Right. It did not come from Wall Street. It did not come from top-down thinking. It came from bottom-up thinking. Mm-hmm. And most all of these riders are insurance constructs. Yeah, the insurance companies say, you're probably going to die. You're more likely to get disabled than you are to die. So you probably need waiver premium.
Yeah, right. I really like what you say about the ones that try to play health insurance. Yeah. It's like, here we've got life insurance companies selling life insurance, trying to pretend to be health insurance companies. Right. So we've got these attempts at something like a long-term care rider, this advanced death benefit piece, or accelerated death benefit, where you can advance a portion of the funds if you diagnosed with a particular medical condition. Mm-hmm. And then there's others that are even titled like long-term care riders or disability riders or disability waivers or these kinds of things.
Yeah. Well, let's talk about
all
that.
All adding extra cost, right?
No question. Let's talk about that for a minute. I'm just sharing with my friend Ryan and all my friends out there that I've yet to meet most of you, and I'm looking forward to that. If we look at that, okay, so the life insurance company across the board, they are the ones that are providing the guarantees that are provided in an insurance contract. All right, so they're providing the guarantees, and the guarantees are backed up by their claims paying ability. But then states are regulated, or life insurance companies are regulated by the states through the National Association of Insurance Commissioners. And then there has to be conformity with federal minimums, right? Because the federal government can manage everything correctly, right? Okay. Penn Treaty was one of the originators of long-term care insurance. So, in the what came to be the typical structure of long-term care, I'm just buying a certain amount of, monthly income or coverage if I'm
a per diem. Usually, if you get some sort of
particular
it
stated
could be
condition. Per diem. Yeah. But if I have to go to a care facility, intermediate care, long-term care facility, and there's different levels, right? So the long-term care policies would pay a specified amount, right? And you may have an inflation rider on there, and you may not. But they're the ones one of the early originators of long-term care, which today in 2019, most companies have withdrawn from that market, right? And there are several reasons. They mispriced healthcare. They miscalculated the life expectancy, and then they miscalculated the lapse ratio. So when people typically purchase long-term care insurance, they kept it. All right. Okay. Yeah. So go figure, the bean counters at the life insurance companies miscalculated all the pricing to properly price this product. Okay. Well, the life insurance companies are making the guarantees that they provide in the policies backed up by their claims paying ability. And then they also participate in the state guarantee associations, right? So there's a secondary guarantee, right? Which, if we get into that, all the states are broke. We live in Texas. They don't have any money, but they have oil and, and gas, and they have the ability to redistribute wealth, right, through taxation. Okay. So even if, all right, look, a life insurance company cannot go bankrupt, right? They're regulated by the states. The states can come into the life insurance company. I've seen this over my 28-year career, and it's only happened to A-plus rated companies in my experience. It's happened to others, but I had direct experience with A-plus rated companies. The state shows up and says, look, you don't have enough reserves on hand today to meet your future obligations in 25, 30 years. So we're going to give you about 90 days to raise some capital, right? So either the company raises capital to have adequate reserves for future obligations, or they don't. And if they don't, then the state will come in and they'll either step in and manage the company. It's called rehabilitation. They'll rehabilitate the company to strength. Or they'll liquidate the company. So this is happening through the Guarantee Association, right? The secondary guarantees. The states are coming in, and they're either going to rehabilitate the company or they're going to liquidate the company. And when they liquidate the company, every other legal reserve life insurance company doing business in that state has to step in and fulfill those guarantees. Doesn't exist anywhere on the face of the planet where a competitor must stand good for their competitor if their competitor goes south financially. Okay, now I'm saying all that to say this. Penn Treaty, right? They've been in trouble a long time. And you can Google it. There's tons of stuff out there on Penn Treaty. They mispriced everything when it came to long-term care. For a company to raise rates, they have to have approval from the state that they're domiciled in, and every other state too, but it starts with the state that they're domiciled in. So Penn Treaty gets in trouble. Their claims ratios are going through the roof. They're losing money. they go to the states and they ask for the ability to increase their premium, and the state limits how much they can increase their premium. And so Penn Treaty just got worse and worse and worse financially, to the point that they went into receivership, and then they went into liquidation. Okay. Now, I said all of that. I know a lot. It wasn't even on the list of things that we might talk about today. Now all the other legal reserve life insurance companies have to pony up money through the Guarantee Association because Penn Treaty was liquidated. All right. This is my observation over the last couple of years. All of these life insurance companies that have these long-term care, extended care riders are taking the name.
Can't drop them fast enough.
Well, or at least change their name, because the Guarantee Association and all of the health insurance companies that are participating in that to bail out companies like Penn Treaty are saying, hey, that life insurance company over there has a long-term care rider. So they're in the long-term care business, so they need to pony up money for Penn Treaty.
Yeah. No, I think that's real. I think it's a very good insight. That's
okay. So we'll probably leave this in the podcast.
Make it in there by the skin of your teeth. No, it is a good point. And so those costly healthcare, long-term care style riders may or may not be on an IBC style illustration. Well, and typically, I think our point here is that if it's built if the policy is built the right way and the premium gets paid the way it ought to be paid, then the policy is going to be naturally robust to a lot of these contingency, who knows what could happen. All of these things that could happen are just possible uses for capital anyway.
That's right.
So if you've built capital the optimal way in IBC style whole life, well, then you've already prepared for that problem. So why take on the extra cost from the get-go in the first place?
And in some cases, it may be applicable to put that on there and to use that.
Sure,
right?
Maybe.
Yeah, he's not minding. Well, I'm just saying that
it is theoretically possible.
Yeah, it's theoretically possible. It's actuarially correct. Right. So I use every rider that I can possibly use that makes sense, and sometimes the additional accelerated death benefit, whatever they're called, ECB, extended care benefit, long-term care riders, depending on the rider and the situation, I will use those in a heartbeat.
Yeah.
I mean, do you know what it costs to go into a nursing home here in North Texas? Look,
lot.
You're not getting in one for under $3,000 on Medicaid.
Yeah.
Okay. If you're self-paying, well, I don't care if you're paying cash, your family's paying or helping, or you're using all your assets, or you have long-term care insurance, a combination of however you're paying for it. It'll quickly get to $7,000 and $8,000 a month.
Oh yeah.
And then if you have memory care, there's another $1,000 or $1,500. And then if you're in memory care and you fall and break a hip, I mean, I've seen it.
There's no wonder the long-term care costs are out of control. $9,000,
$10,000 a month, and that's not the highest in the nation. Anyway, right. So I mean, it's a legitimate threat to your estate and my estate, your estate as well. Long-term care, or the rising cost of health care. So, okay. Thanks for letting me share that, Mr. Griggs.
You're welcome. I don't think anybody could have stopped you if they wanted to.
Okay, but all riders have costs, right?
Yes. And there's one other cost I want to mention, too, as you were going through that very eloquently well put monologue there. There's one other cost that
I appreciate your kind words.
There's one other cost that people could incur, too, if they work with a particular kind of company, and that is the loss on the dividend. If you've got a direct recognition company and you've got a policy loan outstanding year to year. So a cost that's avoidable if you work with a non-direct recognition company, but a cost that you will incur if you do business with a direct recognition company. And if you use your policy, if you have an outstanding policy loan year to year, those direct recognition companies will, they reserve the right to either reduce or eliminate.
Reserve the right. No, they probably would never execute that right. Right. Well, let me share this. Right. So, and I think we've talked about this. Some company, there's not a single life insurance company on the planet that likes first year loans, right? And it kind of gets it's related to the cost of life insurance company from the life insurer standpoint, right? It costs them money to put these policies in force. And I know nobody's losing any sleep, feeling sorry for the life insurance companies. I'm not. There are some direct recognition companies out there, and this has been practiced for years and years and years and years. A direct recognition company, they typically have higher fixed rate loans than a non-direct recognition company. And yes, none of the companies like first year loans. Some of them won't even allow first year loans. So the simple way around that is, well, I can just take the policy down to the bank and collateralize that policy using the bank, right? Mm-hmm. And so my choice is either I go pay 8 or 9% for a loan and receive a reduced dividend, or I just take it down to the bank and borrow their money at 3, 4, or 5%. Right. So yeah, you can do that, and that's a way around a direct recognition company dinging you on the dividend to access the capital. And so can you do that? Yeah. And I've I've heard of several, commentaries, presentations about how, it doesn't matter if it's direct recognition or non-direct recognition. Here's an example to go down to the bank. I've personally done that, and I did it specifically with a company that doesn't like first year loans. Right. And I did it to prove a point. Mm-hmm. Right. So I'm like, I'm going to create this module. And I had a big, lengthy conversations with Nelson while he was with us. I mean, I did this several years ago. And once you get through that, and I'm thinking I'm doing the right thing, I'm going to be able to educate my banker. I'm going to be able to, create a module and show that
through all those hoops.
Oh my gosh. And looking back, why would I ever take the best asset that I've ever owned and expose it to a third-party lender as collateral? Well, there's no good reason. Creating the module wasn't a good enough reason. Educating the young banker wasn't a good enough reason, but I did it anyway. And really the kicker was I had other policies. I maintained control, right, and I could
pay it off if you needed to.
Send the banker packing, Anyway, so my point is, you can avoid that cost. There are several ways to do things.
Right. Like working with a non-direct recognition company.
Well, now listen, if I'm an agent and we know that we have a lot of agents and advisors that are subscribing. Hello. And you guys are the ones that are disliking our videos, and so stop it, all right? And don't need lengthy commentaries on what you do with your clients. We assume angelic intentions, and you're doing the best for yourself and your clients, okay? I mean, it's all peace, love, peace, and chicken grease.
Yeah.
Love, peace, and chicken grease. Yeah, that's it. Okay.
Direct recognition poses costs that it might be good to avoid, I think is the end.
Should that be that's not the only determining factor.
No, you can bank with anything. You can bank with a policy from a company that practices direct recognition and all
farm
that.
Equipment, margin account, CD, mattress money.
One thing I do want to say is that when we get the fee question, I think what people really have in mind is, is this going to leave me worse off?
No, right? I think I don't want you to get paid.
Well, that could be part of it, but assuming angelic intentions, I really think that people, why do we care about cost? Why do people raise the question, what's this cost? What are the fees? Well, if something costs, say, $50,000, but it's going to pay you $75,000, well, are the costs high? No, I mean, it's compared to what, right? So what people really care about, I think, when we get this question is they're saying they've done some homework. The people asking these questions have done some homework. They've read the book. They've gone online. They've listened to a podcast, whatever it is. They want confirmation, validation that this isn't going to, that IBC isn't going to leave them worse off than when they started.
Sure.
And so I like to point out to people that, as Nelson did in becoming your own banker, if you practice infinite banking, you exercise your authority in that contract the way it states you can, you're going to end up on net receiving more. Nelson called it your net or cumulative net outlay, right? How much you could receive from the company above and beyond what you pay in. Many, many more times, orders of magnitude over what you pay in.
Sure.
Right? So are there costs? Yes, we've named them. PUA expense charge, premium on the term, policy loan requires interest, direct recognition could hurt you on the dividend, right?
The policy fee.
There's costs, right? No question there's costs, but over time, look, you're going to hit a cash on cash year. You're going to hit a year when your cash value equals or exceeds the premium you've paid in since day one. And then after that year happens, for every year after that, so long as you continue to pay the premium appropriately, the cash value is going to increase and start to break away from that cumulative premium.
Yeah, let's talk about that for a minute. And I think too, I mean, I want to agree with you. I think that, and I'm not even assuming, I guess I am assuming angelic intentions. I think people, I mean, we all want to be good stewards of our money and everything else that we have the responsibility to manage. You know, we want to be good stewards. We don't want to overpay for anything, but we want good value, right? We don't want to nobody wants to overpay for anything. I think that, you know, these questions of what does it cost? What are they? And getting clarity, I think that's completely legitimate, right? And it's almost a responsibility from the due diligence. I remember Nelson saying many times, whether you agree, disagree, whether it's right, wrong, or indifferent, if I have a total cumulative premium and I compare it to a total cumulative cash value, just like you said, there's going to be some point in time in the future where they're equal, and then the cumulative cash value exceeds exponentially.
It's going to run away from your cumulative premium.
The cumulative premium. Let's just go to that point. And I don't care if it's in year 5, year 7. I mean, I have policies today, 15 years later, that I'm barely cash on cash, cumulative premium, cumulative cash value, right? And we're just looking at an illustration. You have no idea, and I cannot put on that illustration what that capital produced over that 15-year time period, through real estate, dental, medical, automobiles, vacations. And yes, there's a great value in vacations, my opinion. Okay. And some of the, I mean, that's a return that you cannot quantify.
Yep.
Take your children to Europe and expand their horizon for the rest of their life. They have memories. What is that worth? Unbelievable.
Yeah.
Okay. What was the cost of the death benefit in that year? The cumulative premium is outclipped or even equal to the cumulative cash value. And you pick a year that it happens, I don't care what it cost me. It is compared to what? What was the opportunity? What could you have done different? You know, looking at that life insurance illustration, it's like there is no cost. Well, that's not legitimate either, because I might have done something different.
I see what you're saying. So you're going to reach a point where you'll have an asset. Every time you pay into it, it's going to produce more in value than you pay in, right? And so there's a sense in which that is costless. If it were not for the perfect, and I'm not saying it genuinely is, so those analytical engineer types listening to this, you know, don't send me hateful emails, but
they'll be long if they do. there's 2-page email.
There's a genuine sense where there is an actual opportunity cost, and there is, no question. But it's also the case that when you do get to that point, that where your cash value has grown beyond, or even we get to a point where we call the cash flow year that happens earlier, that's when your annual increase in cash value exceeds the premium you pay in, right? And that's going to happen earlier than your cash on cash year. So there's a sense in which after 5 to 8 years, you're paying into a policy, you're going to make a premium payment, and then by the end of the year, you see an increase in the cash value in excess of what you paid in.
Yeah. Well,
so your cost in that case, this is where we can really isolate it. Your cost in that case is this temporary illiquidity. It's that length of time from when you started the policy to when the policy starts to cash flow, or when you hit your cash on cash year, whichever one you care about. There's a sense in which the temporary illiquidity that you have up to that point is a cost.
But that's no question about that. And then you can even isolate that temporary loss of liquidity, because that's what it is. If I paid $100,000 in premium today and I only have access to 70, 80%, whatever it is, it could be 50%. I can isolate that. Let's say it's I paid $100,000 in premium. I have access to $70,000. So I can isolate that $30,000. Right. And I can assume an internal rate of return. I mean, we can all do math and run calculators, right?
Yeah.
And I can say, well, if I put this to work in the real estate and I'm going to earn 20% year over year over year and drag that out forever, which is not likely to happen. But when you talk to the real estate investor, hell, he's not going to do a deal unless it pays 20%. Yeah. He's not going to tell you about the deal, the syndicated, apartment deal that will remain illiquid for 6 years, and it looks like it's going to be illiquid for another 2 years. Oh, and the city shows up and says they got to do this remodel and that remodel and this remodel and that remodel, and then the city, who's the guy that comes around with all the permits? The inspector comes around because he's a brand new inspector and then changes everything that the first inspector required. Yeah,
someone's had some bad experiences.
And I find often, and it's true, the real estate investor, they never, or rarely ever, I don't want to use the word never, they rarely value their own time in that cost. Okay. But my point is that we can all do math, and if I have a temporary loss of liquidity for a time period, I can do inputs with calculators. So we can all do this and calculate what that might have returned. Well, that's the same exercise that you're going to use if I'm going to be investing in turnkey real estate. And I put $100,000 in premium the first year, and I take $70,000 in a loan, and I put that to work in turnkey real estate. We're doing the same exercise. We're going to assume a rate of return, and we're going to assume a time period. You know what I mean? I mean, it's just all math. Math is math. I mean, I hope that helped. I mean, I wanted to say it. It's like,
I think the point is that that temporary liquidity shouldn't be disqualifying. It's that's
no question. But when you get into the cost, and which is what we're supposed to be talking about, right? Cost. We are talking about it. Okay. That's just one cost, that loss of liquidity for a time period.
Yeah.
Okay. Just like your time, effort, and energy as an investor, as an IBC policyholder, whatever deal it is you're doing outside of the policy, you've got to account for your time in that. Oh, wait, and the CPA has to sign off on it.
I see what you're saying.
Okay. The K-1s, have to be provided, and you've got to spend your time
I see what you're saying.
Coming up with 2 years of audited numbers. All of that has a cost. So that doesn't show up anywhere on here.
So typically when people, if they attempt to compare IBC-style dividend-paying whole life with some other asset, in this case an investment, something they often discount is the value of their time that's spent on the other investment.
Question.
Yeah, okay.
And then
I get you.
Right. And then and then I'm just saying that when you're comparing asset to asset, there's all kinds of calculations that you can do. Right, and to determine the cost, and I was just talking about the cost of liquidity, the loss of liquidity for a time period, and then your time and effort as the investor, the entrepreneur, the business owner, the individual. We all typically discount our time in the deal, right? It's just another cost. Is all I'm trying to point out, but. When the further out you go in all of these illustrations, right, or any investment pro forma or projection, the further out you go, the better the numbers look. No question about that. We're talking about going forward to a time point, in your example, as an annual cash flow basis. Premium in, cash value increase in that 1 year. Typically happens in years 3, 4, 5. Right, the total cumulative premium paid and the total cumulative cash value typically equal somewhere between 7, 8, 9, or 10 years. Right, depending on the premium, the age of the person, what it is they're trying to do, which really gets to the correct foundation or the correct basis to build policies from. It's what are you trying to do?
Yeah.
How old are you?
I would just stress with anybody who's looking at those initial time periods, going back to what I said earlier, that I think what is at the back of people's minds when they're asking about cost is this on net going to leave me better off? Yep. My encouragement is look over the entire time frame, right, which is your natural life, right? Don't stop at 5, don't stop at 10, 15, 30, whatever the comparison with the other asset is. Go all the way out, right? Account for all of the growth, all of the value that you'll receive by practicing the infinite banking concept over the course of your lifetime. And then compare that to whatever sort of cost you might have. And I think you're going to find that the cash value, the access to capital, the value of which is unknown, right? Having the ability to draw from capital under your own ownership and control, the access per se has a value that's not on that illustration, right? But just its value, the numerical amount itself, will far and away exceed the amount you pay in over the time of over your entire lifetime. And then of course up to that point, over the from day one when you start a policy to however far out you want to look, you also, not only do you have the growth, not only can you compare the growth in the cash value relative to, say, cumulative premium since day one, you can do that, but you also have the use of that money, right? You can borrow against it, access a policy loan, use it for what you're going to use it for anyway, while still enjoying the compounding growth on a guaranteed basis, tax deferred. I think if you do that, if someone takes that perspective, they'll find that the benefits run away with the show. It's like costs. And that's why I think that most people who, if they've done some research and if they've looked at, for example, the illustrations in Part 4 equipment financing of becoming your own banker, usually they're just asking this question to make sure they're not missing anything, or they just want that validation. Of course, there are the people who that's not the case. That's one of the many questions that they have that they will continue to have.
Well, what is their case? Who are these people you speak of, and what is their case? So I think what I have found is, the people that are focused solely on the loss of liquidity, they really never got past the word life insurance. Mm-hmm. They can't get past the cost of the death benefit, which, this industry has terms like every other industry. And when you say cost of insurance, you're specifically speaking of a universal life term, COI, cost of insurance. Now, and I understand these terms bleed over. Whenever you're looking at the infinite banking concept, you cannot correctly say that the cost of the insurance is in the base portion of the premium. So therefore, I don't want a death benefit. I do not want to pay for insurance, i.e. the death benefit. I want the cost of the insurance as low as possible. So if I'm going to pay $100,000 in premium, I want only $5,000 to go to the cost of the insurance, and I want access to the $95,000 in cash value. I mean, so my point being is, you look at whole life insurance, typical whole life insurance, with no additional PUA rider other than the dividend to be paid into. Even those things break even in 14, 15, 17, or 18 years, which I understand nobody wants to put their money out for 18 years unless they're doing an IRA or 401k or real estate, right? I get it. Okay. So the premise to start from, the basis in which if we do the vetting, we go over, consider all of the cost, and I think you're bringing up very good points. I think we're bringing up very good points. There are costs associated with everything you do in the financial world, right? And they're not all going to show up on your bank statement or your investment statement or your life insurance illustration or the annual report, or you know what I mean? But the opportunity cost exists. A lot of people talk about that. The commissions are they're an expense to the company. The consumer pays for everything. It's just a distribution cost to the life insurance company. They're either going to use captive agents, which means the captive agent can only write for that one company, or they're going to use independent agencies or agents. and the independent agent can represent many companies, or they're going to go to the bank, right, and use the bank distribution system or the brokerage house. It's just a cost of distributing the life insurance company's products, right? It's all the same. If you think about that, and two, there's a reason that there is no cash value in the first 2 years, or very little cash value in the first 2 years of all whole life insurance, because the company actuarially weights all of their cost into the first 2 years. And then they amortize the rest, or the remaining of that cost, over the next 12 to 14 years.
Yeah. That's an important part to point out too, is that the heaviest part of the cost structure is in the initial years of a new dividend paying whole life policy, both those built for infinite banking and those without, right? So I tell people, look, if you pay 2 premium and then graduate early, life insurance companies receive 2 premium, they got to pay a substantial death benefit. That leaves the life insurance company in a hole. That's a cost. There's a risk to that, and the consumer pays to compensate for that risk.
And the life insurance company does not want to pay the death benefit anytime soon. That's why you have to go through underwriting.
Yeah. So if for whatever reason you started multiple policies when you could have just started one, well then, even though you're paying out the same amount of dollars in the form of premium, you're going to incur greater cost relative to had you just put that money into one policy, right? So we've mentioned the stacking or laddering in the past, where you
yeah, and we should probably do another podcast on stacking, laddering, velocity, accelerating, leveraging, financing life insurance policies. So that cost that's weighted in the first 2 years, with all permanent life insurance, right? There is a loss of liquidity in the first 2 years, and that's where it comes from. That's why it exists, because the companies have weighted their cost in the first 2 years. Wonder why? Most people probably don't keep their life insurance their whole lifetime. They've got to weight it up front in case you get mad and change your mind in the 5th year or the 6th year. You know what I mean? It's like, and those are the kind of companies, speaking of mutual companies, which is, we talk about all kinds of companies, but we use mutual companies with the infinite banking concept. That's the kind of company I want to be part ownership in. Conservative. They think long term. They've been around long term. They pay dividends long term. That's financially astute for the life insurance company to weight the cost in the first 2 years, right? I'm okay with that.
Yeah, me too. All right, I covered everything I wanted to say. You got anything to add?
Yeah, let me look over my list here. We covered the startup cost, which Nelson, conveyed this loss of liquidity for a time period as a startup cost. You go into any business, there's a startup cost. And most businesses don't show a profit for 7 years. And, just because I go into business, if it costs me $200,000 to go into business, or $20,000 or whatever it is, I'll pick a number, $20,000. It costs me $20,000 to go in business, and I generate $10,000 in revenue that year. It is not a profit.
That's correct.
I'm saying that on purpose, right? It is not a profit. Okay. So there is a startup cost. That's the way Nelson conveyed it. And
don't be afraid to capitalize.
And think long range. And so, no, I have so much more to say. Are there fees? Yes. Are there commissions? Yes. Now, and I don't want you to work for free. I don't want you to work for free. And if you want me to work for free, we probably can't work together.
Right.
I'm just saying.
Absolutely.
That probably should come out. I don't want to convey that. I just won't work for free.
Yeah.
Neither will you. Neither will anyone else. Okay. I could summarize all of this one more time, but I won't.
Okay. Good.
You're like, okay, good, awesome. All right. Okay. I had fun. Hope you did too. Hope you found it beneficial, and come back and join us next week.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe. Otherwise, find us wherever you get your podcasts and subscribe to join us weekly.